Hello, you're welcome to uh, this concept of cost of capital. So, I'm going to give you a conceptual overview of what we mean by cost of capital. And this chapter or this concept is a continuation of what we learned previously on valuations and rates of return and also on time value of money. So these techniques or these tools that we have learned so far are going to be important as we look at cost of capital. Now, from our general understanding, that we know that again the assets for a farm are financed uh, in two ways, either through debt or through equity. So it's either debt or preferred stock or common stock. And we can look at this further by what we mean by debt, we're looking at notes payable and long-term debt. So we don't look at the short-term sources like accounts payable. Our focus is more on notes payable and long-term debt. In terms of equity, we are looking at the use of retained earnings, or if the firm decides to issue new common stock. So, generally speaking, our focus in the chapter is for us to be able to determine or be able to compute what our cost of capital is. Now, the cost of capital is very important in finance because we use this to determine the selection of investment projects. Just like we did in our previous chapter on valuations and rates of return. The rates of return is what investors are demanding for providing the funds, and they provide the funds by either again through bonds or again through issue of shares, common stock or preferred stock. And what we saw, we were able to determine how we can compute the required rate of return again on bonds. We did that, and bonds again we are looking at yield to maturity or just the yield rate. On preferred stock, there is also a required to return on preferred stock again, or for the common stock, there is also a required rate of return on preferred stock. In addition to that, what about if the funds are we're using our retained earnings to determine uh, uh, to use that for expansion in the business? For that case, again, then there is an opportunity cost when the company decides to use the retained earnings, because these funds could be used somewhere else, but they decide to forego that and use the firm's retained earnings. And therefore, there should be also a cost that is associated with retained earnings. So let's see how this goes. Again, this is a quick conceptual overview, just for you to give, to get a bigger picture of the chapter. And then later on, what we're going to try to do is to look at some examples and compute what our waste of capital is. Now, just to summarize some of these objectives is the cost of capital represents the weighted average cost of the source of financing to the firm. And I've given you here the formula. The formula we're saying is a weighted average. It's the weighted average cost of capital. And we know that the capital is coming in different forms. The capital is coming as part of debt. We see the R&D is there. It's also coming from preferred stock, and therefore that is our the cost of preferred stock. It is also coming in terms of common stock and the RS. So the RS here represents our cost of equity, our RP here represent our cost of preferred stock, and R&D here represents the cost of debt. And therefore, because we are talking about a weighted average, so we have to determine how much of debt is being used to finance the company's operations and how much of that uh, preferred stock is being used and how much of common stock is being used. So the weight here, the WD, will be the weight of debt. The WP will be the weight, that's the percentage or proportion of financing, and the WC will be again the proportion of the common stock that is being used in the operation. So what you could see is, for example, saying the company is using 40% debt and maybe using 20% preferred stock, and therefore they're also using 40% of common stock. Again, the question we're going to address later on in the chapter is what is the optimum value or the optimum number we can reach? Is it 40 20 40, or could this be 30 20 50? So the proportion of that weight is an issue we're going to address to find out what is the best optimum proportion of this, so that again we are able to minimize the cost of the cost of capital for the farm. So what is that number? What's that magic number? Again, we can address that towards the end. So the cost of capital is normally the discount rate that is used in analyzing an investment. And we saw this in our previous chapter, because we said our discount rate, again for the bond, you saw the yield to maturity. And therefore the yield to maturity is the rate that we were using to discount the future cash flows, which for the case of a bond was those interest revenues, and of course discount also the face value of the bond. So that rate is what we refer into in terms of debt. In terms of preferred stock, then again we are able to determine what that rate is, and we saw how to compute it. And again, for the common stock, we did the same thing. So this chapter again is just a true reflection of what we did on valuations and rates of return. And you'll see this as we cover this material. So the cost of capital is based on valuation techniques. Again, we saw that. For example, if you remember when we were looking at valuation of common stock, we said we could use different models to determine the value of the a common stock, or determine, of course, the required rates of return. Remember, we said we can use the corporate valuation model, which is something we didn't touch so much on it, but that's a model we can use. We said we can use the security market line, and again we say we could also use the discount model. So remember that several techniques that we can use to discount or to determine the value or the required rate of return for common stock. So we're going to again to go back into those details. Then a firm attempts to find a minimum cost of capital through, again, you're trying to vary the proportion. How much of debt do you need? How much of preferred stock do you need? And how much of the common stock? So by you varying these proportions, you're trying to strike a balance of where you minimize that cost of capital. Again, we're going to explore this towards the end. The cost of capital may eventually increase as large amounts of financing are being utilized. It's just basically just true. Even for an individual level, the more you borrow, the more you increase again the chance that you might not be able to access funding at a lower rate, because again you increase your risk. As you borrow more, your risk level increases, and because of that, it ends up affecting your the cost of borrowing. So that also applies to organizations. So again, keep in mind our cost of debt we are talking about here, we are talking about the after tax cost. So therefore, what we're going to try to do is to eliminate or determine the cost of capital without the effects of taxation. Why? Because remember, some of these sources of funding are tax deductible, and because they're tax deductible, we have to take out the tax element. And a good example of this, of course, is going to be on a debt instrument. For example, bonds, you're paying interest, and because you're paying interest, that interest could be tax deductible, and therefore that reason we try to determine the cost of debt, again less the taxation element into it. That's what you see in this formula is the weight of debt times the cost of debt, but less, of course, the tax, which could be, again, if that's 20%, there'll be 1 minus 20%, or 25, 1 minus 25%. Again, we're going to see how this works out. So again, we are more concerned with after tax cost. In the case of preferred stock, we don't have that issue. In the case of equity, again, we don't have those after tax elements. So for that reason, we only apply this mostly on a debt instrument. Again, most commonly on bonds is where we see this. So therefore, we have to adjust our cost of debt again by taking care of the tax. So basically your cost of debt will be now, which will, again, in my other slide is R&D, will be then be the cost of debt, which is this, and therefore because of tax we can deduct the tax, the interest on a debt instrument, and therefore we have to remove that issue. The 1 minus T is going to be applied. So let's look at how we determine the cost of preferred. So again, this is just a continuation again of what we did. And again, the when it comes to preferred stock, again, you basically promising to pay the preferred stockholders a dividend, and therefore the cost of the preferred stock, generally speaking, is going to be the return on that stock. So the return on the stock, on the preferred stock, should then represent our cost of preferred stock. I want you to stop and think about this. That's where you're trying to connect the previous chapter and in this chapter. In the previous chapter, we were trying to value financial instruments. We were trying to determine the price of debt, and that's bonds, and determine the price of the preferred stock, and of course determine the price of common stock. For the case of preferred stock, if you remember, we basically said if you want to determine the return on a preferred stock, you basically will take the return on that stock divided by, of course, the price of that element, right? Because in our previous chapter, what we did was to determine the price, and we said the price will be equal to the return divided by will be price will be equal to return divided by the required rate of return for preferred stock. I just say is PS. So this basically the required rate of return. This is what we did. And therefore, if you're looking, so we in this chapter we're looking for, we just basically using the same formula, but we're reversing. What are we reversing? Our concern is to determine what that required rate of return is, and that's why the required rate of return is going to be the return divided by the price. The return on common stock, of course, is the dividend. So you'll take the dividend divided by the current price of the stock, and this will give us required rate of return on preferred stock. So we need to know the selling price, and we need to know how much was the dividend that was given out. And then from there, we can determine what our rate is by just taking the dividend divided by the price, and that will give us again the uh, the the cost of preferred stock. But again, here we're assuming there is no other cost associated with issuing out preferred stock. However, if you end up having some selling cost, then in that case, then what you're going to do is you have to minus the selling cost from the price, because initially you're saying I'm incurring 10 cents to sell one preferred stock. If that's the case, then the cost of issuing that preferred stock should be taken out from the price of the stock. And given that, then what you'll do is you'll still take the dividend, but then the price is going to be the price less the what you call the flotation or the selling cost. Again, they're very minimal in terms of the preferred stock. So generally speaking, we always ignore the flotation cost when it comes to preferred stock. But you will see we're going to use this when it comes to common stock. If there's an element of flotation cost or selling cost to do with the trying to issue those stocks, then we have to determine the cost of the flotation cost per stock, and then take that out of the selling price of the stock. So again, by formula, the cost of preferred stock, which will be the KP or PP, whatever you want to use it for. Again, just basically saying it will be the dividend paid out divided by the price of the stock less the flotation or the selling cost. Again, that will give you what your return is on that particular stock. And here they give an example. So assuming you have uh, an annual dividend of $10.50, and the preferred stock is $100. That's the selling price, and the flotation or the selling cost is $4. So to determine the required rate of return, which is the cost of capital on this stock, on the preferred stock, then you just take the dividend paid out, which is again 10.50, and you divide this with the selling price less the flotation cost, 100 minus 4, and therefore this gives you a 10.94%. Again, this is the number that we are using to determine the price. So if somebody was asked you to determine the price of this, in this case, we're trying to determine the cost of capital. But if somebody was asking you determine the price of this preferred stock, then again, what you do, again, you'll take the dividend, which is 10.50, and you divide this with the return, which is 0.1094. So if you divide these two, again, this will take you back to the price, and then of course you just have to add there the flotation cost, and that will give you again back the $100 that you are seeing in that scenario. What about when it comes to common stock? How can we determine the value or the cost of equity? When it comes to common stock. Again, remember, we're just using the same formula from what we learned and trying to apply this formula to this chapter. In a previous chapter, if you remember, again, we were looking to valuation, how we determine the value of common stock, and we said to determine the current price, we take the dividend that is paid in year one divided by the return on the dividend less there is growth if there is a constant growth in those dividends. And therefore, this is the same thing saying you take the current uh, dividend, you take the current dividend and then times 1 plus G, and then divide this with the KE minus G. That still gives you the same thing. Again, this is just representing dividend paid in year one, which is basically the same as that. So we divide that with the K, uh, no, no, KE minus G, and that will give us again our current price. But in this example, we are not looking at the price. What we are more interested in is how we determine the KE. So what you do, you again, basically what you're going to do, you're just going to revise that formula and make KE the subject, and by so doing, that will give you what the return will be. So if we just make changes there, that will give us our cost of capital. Then, as I said before, there are several techniques. Again, don't mind about this. We're going to look at an example later on how we determine the cost of common equity. I'm just trying to give you a conceptual perspective of the chapter or the concept. And then, as I mentioned before, we did look at several ways we can value common stock. And we said, for example, we can use the security market line, we can use the discount dividend model, which is basically this. This represents our discount dividend model by using the dividends to determine, of course, the value of the stock, or to determine, in this case, the required rate of return on the stock. But we can also use the another model called the CAPM, the capital asset pricing model. And we can use this to determine, of course, what our required rate of return is. But for us to use this model, we need to know the beta coefficient of the stock, and we need to know the risk-free rate, the R&F. So we need to know the risk-free rate. We need to know our beta coefficient for the stock, and we need to know uh, the market premium, and take out the market premium minus the risk-free rate. It gives us the premium itself, and we model that premium with the beta, and then we just add the risk-free rate. Again, if you think about it, we're basically saying is this, that the the rate that you end up paying is going to represent our risk-free rate. And then because of the nature of the risk inherent in that particular security, then we have to have a premium on top. That's what we see now. The KM represents the premium. So the KM is a return expected in the market as measured by an approximate index. And we're going to see again how this works out. Again, I know you didn't see this previous conversation, but again, this is the first time we're going to be introduced to this. But I just want you to think about it is, if you think about this is basically representing some kind of a line. And again, if you think about it, it's showing almost like a regression analysis. If you just think about it, if you draw that line, again, I don't want to go there, but I'm going to explain this later on. But I want you to see that what this could represent could be a line like this. Again, from mathematics, in high school class that you took, I'm sure you understand gradient, for example, regression. And therefore, what you're seeing, the R and F here, this is being represented where that line cuts the y-axis. So you have a y-axis here, and you have the x-axis. So where the line cuts the y-axis represents, of course, the risk-free rate. And the B here represents the slopeness of this line. So this is what we call the gradient, or how steep. So the steepness, or of that particular line is what that B is, which again, that's basically the the beta coefficient, right? Uh, Again, that's how you're going to think about it in terms of how can I look at security market line, security market line and think from that perspective in terms of the CAPM model. But again, we're going to look at an example on how we go about it. And there's one given there, but we shall see more examples, as we walk through this. What about the cost of retained earnings? Now we know the cost of common stock, but what about if the firm decides to retain the dividends, and therefore they want to use this for further expansion and so on? So is there a cost associated with retained earnings? And of course, again, the answer is going to be, of course, yes, because if you don't retain the funds, then you can give to the shareholders, and what they can do is they could invest this money in somewhere else, either in other companies' stocks or shares. And therefore, because we decide to retain those funds, there should be a cost associated, a sacrifice. There's an opportunity cost, that goes hand in hand with those funds. Because of that, again, we need to compute the cost of retained earnings, and that will be part of our discussion later on. Or if the firm decides to issue common stock, and again, we could use the issue of common stock as a way of trying to determine if that should signify the cost of the retained earnings, or we could use our current cost of common equity to determine whether that should represent the cost of retained earnings. So the cost of new stock, of course, is going to be higher than our current cost on the existing shares. And the reason is because when you issue new shares, you have to incur some selling and administrative cost. And because of that, you'll end up having a higher required rate of return or a higher cost on the issue of new shares. So again, we just pick up the same formula as we know from a previous chapter, where to determine again our, because in the previous chapter what we did was to say, for us to determine our P naught, that's the current price of the stock, we take, of course, the dividend paid in year one divided by, of course, the required rate of return on the stock plus, of course, the growth rate. And that's what we did. And therefore, in this case, we are not looking at current price, we are more interested in KE. And therefore, what K is going to be is just going to be the D1, dividends paid in year one, divided by the current price, and then of course plus G, and that will be our required rate of return on new issues. But because the new issues are going to have a flotation cost element or a selling cost element into it, we need to again to do that to reduce our current price, with the value or the charge or the cost of each issue of new share. So by so doing, then what you end up having a higher rate than what you have here. So here you have a higher rate, higher required of return than in this case, because remember, you're taking the dividend divided by a price, and the price is much further lower because you're taking out the flotation cost out of that, and by so doing, you end up having a higher cost of capital when it comes to issuing new shares. So now we have seen what our cost of capital is in terms of on a preferred stock, in terms of common stock, and on bonds. Again, we know the bonds is basically the quality return on that's the yield to maturity, represents the cost of capital. So the question we try to ask ourselves again as we cover this is there an optimum capital structure? Is there a lower, can we minimize that cost of capital so that we have a lower cost of capital. And again, to address that question, what you basically do or try to reason is, yes, we could try to minimize our cost of capital by trying to vary different elements. What we're going to try to do is to vary the amount of debt, the amount of preferred stock, and maybe the amount of common stock or new issues. So if that's the case, then what is that optimum? What is that magic number that we're trying to figure out? Again, it becomes a tricky, it's not an easy discussion to say, yes, we can strike that balance. But what I want to show you here is basically three scenarios that are basically trying to illustrate the point. Yes, you could strike some kind of a lower number to reduce your cost of capital, but I don't know whether that number is going to be the optimum capital structure, but it's going to lower your cost of capital. So, for example, if you look at plan A here, they have a debt and the cost of debt after tax is 6.5%. On then the equity, the cost of capital is 12%. Then the weight, how much do they have in debt? Debt represents 20% of financing, and equity represents 80%. All in all, our weight cost, again, for each element, for the debt is 20% times 6.5 is your 1.3, and for the equity is 80% times 12, you get 9.6. In total, our weighted average cost of capital for under plan A is 10.9%. How about under plan B? Under plan B, the only change you're going to try to do, again, you have a different cost of capital, but again, you also make changes as far as the weights is concerned. So you don't have to, you basically reduce the amount of equity from 80 to 60, and you also increase the amount of debt. And by so doing, what you end up seeing is a weighted average cost of capital of 10.3%, which is slightly lower than what we had under plan A. Plan C, you look at this further, and under plan B, what you do, you increase the amount of debt and reduce the amount of equity proportion. And by so doing, again, you end up having a higher weighted average cost of capital than even under plan B and plan A. So what does it tell you? So what we're trying to say here is, yes, the more you borrow, which is true in terms of debt, the more you do it, you reach to a point where your risk increases and your cost of capital goes higher. Because again, the truth is, yes, you borrow more, the risk level goes higher. That's just true. But you reduce the amount of borrowing, then of course that also reduces your weighted average of cost of capital. But what is that number? It's going to it could be the optimal number. So in this example, we could say plan B becomes a better number for us. But could that number be different? I'm sure yes, it could be different if you end up again changing the weight. So again, this is something you can use a model and you do through modeling, and you can decide and to try to reach an optimum number, what that could be based on what the required rate of return is on the individual instruments in terms of debt, preferred stock, and common stock. And then from there, you reach somewhere where the cost is going to be lower, but I don't know whether there will be an exact optimal capital structure, because again, this is an issue that is still being debated on whether it really exists. But again, is a discussion for finance, and that'll be something to think about. So in summary, what I can say is, again, the key point is for us to determine the cost of debt. Again, this is the after-tax cost of debt. We need to know how to determine the cost of preferred stock, and know how to determine the cost of common equity, and of course the cost of new common stock. And we're going to look at examples in our next video where we can look at some examples on how we determine the cost of capital for each element, and then at the end, of course, how we determine the weighted average cost of capital. So again, that number is going to be very important to us, because later on in the future chapters, what we're going to try to do is we're going to move into budgeting, where we have to make some financing decisions on a number of projects. And for us to select even project A and project B or a C or a D, what we're going to try to do, of course, is we're going to look at, again, the present value element is going to into play. The net present value is going to be at play. We look at the cost of debt at play, because again, you cannot make an investment decisions if you don't have if you don't know what is costing you in terms of financing. So in that regard, I will stop there. Let's see, watch the next video, which is going to cover again some of these issues on some examples and how we get down to the weighted average cost of capital in terms of how we compute the value. So I hope the information helps, but let's look at this in our next segment.